Hey, Matt Robison with Mike Morton on 5 Minute Finance. This is the show where we are practical, simple. We take stress away, we hope, or we stress ourselves out. We're not sure. But we are trying to get to some very simple, practical approaches to dealing with your finance and your other to-do items in life. Mike, you wanted to talk today about how to evaluate investments. First of all, I don't know. Can we come up with a better word for that? And second of all, why do you want to talk
how
about
to pick your how to pick your investments? How to pick winners? How to pick your winners?
Yeah. What's the take home here? Why is this valuable?
Well, there's a lot of different ways to go about choosing what to invest in, and I want you to make smart choices about how to do that. Have a framework for how to do that. So today I'm going to show you the 4-part framework of how to pick your winners, pick your investments.
Oh, I see. So it's not all like just throw a dart at a board and whatever target date fund it lands on, that's the one for you.
There you go. That's it.
Because I tell you, that's the system I use and it's bad. All right. So, and people, please stay tuned because we have our regular features, our listener question. And today we have a question from a truly confused listener who got lost in like an enchanted forest of financial problems, and Mike guided them out. Mike is Gandalf. And hold on for our one thing segment at the end where Mike has the most practical piece of advice that is also de-stressing imaginable. And I love it. So, okay, let me just, can I challenge you for a second here? Why is the answer when you're saying like how to pick your investments? Why is the answer not, just low cost index funds? That's the end.
That's the end. But which ones, Matt? Where? How? Low cost. Yeah. So we do talk about low cost index funds all the time, right? But there's also this notion of like, maybe we're in a volatile market. They haven't done so well. Like things have gone down. Should I be in, slightly different stuff, a different target date fund? Should I be in international, or should I be in, the Magnificent Seven? I was kind of overweight and large. Like, should I be doing something different? So yes, low cost index funds, we preach that. But we want to take it a little bit further today, how to be looking at your overall portfolio and how to think about investments kind of holistically.
So I'm going to ask you to blow up your entire business model and give away for free what you have spent years developing in the way of expertise. So how do you, as a pro at this, how do you evaluate different investments? How do you choose among the low-cost index funds?
Yeah. So the first framework I like to give is that there's 3 places you can look for getting investment advice, from individual stocks to whole portfolios. One is Wall Street, right? You can listen to the people on Wall Street and the products that they have and the economic outlooks and what they're pitching and all kinds of stuff,
Oh, I'm already gouging
CDOs
out my earballs.
and collateralized, loans and all kinds of cool stuff.
Gosh.
So you can listen to Wall Street. That's and there's buy and sell, right? Like, this is a buy, this is a sell, and here's credit ratings and all this stuff. So all that comes from Wall Street, and it's a massive industry. Right. So you could listen to Wall Street. The second place you could listen to is what we call Main Street. It's your neighbors. It's taking in local investments. I did really, I invested in this. It's been doing great. Or I work for this company. We're about to, do this great thing. So you can listen to your friends and family and go to the local bar and get some investment tips from Main Street.
So just so I can write this last part down, Mike Morton says, go to a bar to get your investment tips.
I said
Roger.
You could.
Oh, okay. All right. Fine.
Go to the local bar. Does anybody go to the local bar?
All right. So you said there are 3. So you go to Wall Street. You could go to a bar for like Main Street.
That's right.
Which I do.
Yep. Or you could look at the academic research. So there's lots of institutions, PhD students, slicing and dicing, because everybody wants to know what's the best thing to invest in. So they've done the research, looked at the last 100 years, slice and dice data, should you invest in large companies, small companies, US, international, stocks versus bonds. And so I lump that all into academic research in terms of what's the best way to go about doing your investments. And shocker here, Matt, I use the academic research. as to really evaluate how to invest in portfolios, how to look at your overall investments, and the research not only from past returns and kind of putting that in context of stocks versus bonds and US versus international, but also research in terms of spending patterns and retirement patterns, and making sure we have the right portfolios to enjoy life the way that you want to.
This is going to sound like a tongue-in-cheek question. It's really not. Is that because it's unbiased and fact-based? I mean, there is like a wisdom of crowds argument for saying, the Main Street, all joking aside about going to a bar, like, you could kind of crowdsource like what's happening on Main Street. Or you could make an argument for like, look, I know people on Wall Street are trying to sell you something, but this is also the business that they're in. So, I mean, is that why you tend toward the academic side?
Yes, that's right. And I do think there's wisdom of crowds, but how are you going to use that? So that's where I think the pricing is a great wisdom of crowds. So it's the whole jelly bean experiment at the fair, right? How many jelly beans are in this massive ball? And no one person is very accurate at all. But if you average them, they're extremely accurate. And so that's the wisdom of crowds. And that comes into the pricing of stocks. How much is NVIDIA worth? Well, any one person that I meet at the bar is going to be wildly off with their comments. But when you look at the actual price that everybody's bidding, buying and selling, it's going to be somewhere in the realm of pretty accurate.
I see. You promised me a 4-part investment framework that you use and that you will pass along for free to everyone to pick their investments. Yeah. Should we reveal it?
Let's go through. We'll give you the high level. The 4 parts are asset allocation. And this is the biggest part. We'll probably spend a little bit of time on. Low cost. All right. So how to pick the actual funds. Asset allocation, then keep things low cost. Then you want to rebalance your portfolio periodically. And then pay a little bit of attention to the market, not in terms of market timing, but just kind of where are we in the cycle. So that's the 4-part. Asset allocation, low cost, rebalance, and market.
All right, well, let's hit the first one. You said that this was sort of the biggest one, asset allocation. Yeah,
before we dive into the asset allocation, I do want to mention the way to think about asset allocation. There's big companies, small companies, US, international, and then there's kind of index funds, actively managed funds, and we talked about that before. The reason I stay away from the Wall Street recommendations, they're notoriously pretty terrible. But the thing is that the research says among the top quartile of funds from the last period, okay, so you were the best performing fund, for the last year or last 3 years, they never stay at the top. They always end up, in the middle or at the bottom. So if you listen to like, hey, this is doing well, or you listen to past performance, right? Past performance, it's just a terrible predictor. And so that's why we really don't want to look at past performance. We want to look at historical asset allocations and then see how they look kind of going forward.
I see. And is that why you start with asset allocation as the first part of the framework? Because that's sort of the biggest piece of this. It's like, don't start at the level of like picking like, oh, that's doing well, or, this, you want to just start at what's the overall allocation.
Yeah, that's exactly right. And where you start there is stocks versus bonds. All right. And the reason why is because I use bonds and stocks both have a wide range of variability. You can invest in kind of different pieces of them. I use bonds as very safe bonds. So very short-term bonds, very safe bonds. I want it to be around. I want it to stick around. I don't want to lose money on my bonds. So when it comes to asset allocation, depending on where you are in your journey of life, you might need some cash for the next couple of years, or you might also just want to have some safe assets that aren't going to go down. And so that's why I always start with stocks versus bonds. Take a look at what you need for the next couple of years, 2 to 5 years, and make sure that money is going to be available to you and is not going to lose 20, 30, 40% of its value like stocks can lose.
I see. So, and you've gone through on this show various ways, shorthands to think about it, in your buckets in terms of the time frame that you're going to need it, but the take home is asset allocation. So what you're talking about is just maintaining a diverse portfolio of investments that balances appropriately stocks and bonds, and has an eye on kind of that time dimension of here's what I need short term, here's what I'm investing for the long term.
Yep. That's where I'd start with at least the stocks versus bonds. Okay. And then once you know how much is going to be in stocks, whether it's 80% or 70% or 60%, then the question is what kind of, stocks. And the historic research, as we've talked about, all is pointing towards low-cost index funds because they're not actively managed, so you're not paying for fees. We're going to talk about that in part 2 of the 4-part framework. But so you want to stick there, but it's, stocks, are they big companies, small companies, US companies, international companies? So you might want to do a little bit of diversification across those various parts. And the whole point there is what we call the efficient portfolio. Some things are going to go up, some things are going to go down. We just don't know what they are. And so if you hold a little bit of everything, you both get to enjoy some of the ups and also commiserate about some of the things going down. There'll always be parts of both in your portfolio.
We should get to the second part of this. I will just say on that last point that I am, as a former federal employee, I've been part of the federal savings system, and investment system, and they give you very broad categories. And I literally had a colleague of mine say, well, do most of it in this fund, that's broad domestic, like 10% in the international, this percent in small cap. I just did it. I just did what that guy said 20 something years ago. It's performed absolutely great. Did I optimize it? Heck no. But I think it's one of your take home messages, which is like good enough is great. Like, pretty close, simple. That was the way to go. And it has performed absolutely wonderfully, actually outperformed some of my other investments in other places. So, yes, good diversification.
Part 1A should be like, set it and forget it. Once you have your asset allocation, like set it and forget it. So just on that note, Matt, I totally agree. US versus international, some people be like, oh, you should be 50-50 or 70-30. Whatever. It doesn't bother me, whatever, too much. Answers. There's a lot of right answers. And then if you listen to Warren Buffett, he's like, why would you invest internationally? Just put everything in the US. Yeah, right. That works too. Those big global companies, they're based in the US, but they get lots of their money from overseas. So the point there is like pick an allocation that kind of makes sense to you. I do have a home bias. I would be a little bit more US, so that way when you look at your neighbors and you read the news, you're sort of chugging along the same way that they are. But otherwise, set it, forget it, have a good allocation, and you'll be great.
Number 2 is so self-explanatory, although you have a tiny piece of practical advice, I think, embedded in this: low cost.
Yeah, low cost index funds. This is from a white paper at Personal Fund. The average pre-tax return on a mutual fund is equal to the return of its asset class, less the fund's expense ratio.
Right.
Full stop.
So you're going to get the average return, but if you pay fees, if you pay expenses, it comes off of your returns. That's self-explanatory.
If the US big cap companies are making 10% last year and you're in a fund that charges 1%, you get 9%. There you go. And that doesn't sound like a lot, but it just adds up. It compounds crazy. So keep low cost. So once you've decided I want the total US stock market, just find a super low cost index fund. Once you get, and I do run across this, Matt, once you get like below 0.1%, don't stress about it. Like we're not looking for like, oh, this one's 0.05, this one's 0.03. Okay. Like we're now below 0.1. It's basically costing you almost nothing. Don't stress from there. So like even the free ones, like Fidelity has free funds. They're not really free. There's embedded like trading costs and other stuff. So don't get too caught up once you're in that super low cost range.
Right. Well, again, it's back to the last point. It's like pretty good is pretty great. All right.
Yeah, exactly.
Number 3, rebalance. I suppose that's if someone knocks into you and then they do it again, you have to rebalance.
You have to rebalance and stand back up.
two times.
Yeah, this is your portfolio. So you set your portfolio to some allocation, and then every now and then you want to check in and see if it's still at that current allocation. There's a lot of research.
One side of it could grow faster than the other. So you thought you were 80-20 and suddenly you're like 60-40.
Yeah, that's exactly right, because you were 80-20 in stocks versus bonds 2.5 years ago, and now you're like 85-15 because stocks have done really well. So you want to get back to that 80-20. And the whole point there is it doesn't sound like a big deal, 85-15, 80-20, but you're selling high and buying low. So if you have some US versus international stocks, by checking in every so often, you will automatically be selling high, whatever's gone up, and buying whatever hasn't done quite as well, buying low. So it's an automatic way of doing that. And there's a lot of research that says you'll get a small boost return. And remember, small returns compounded add up to a lot. Now, yeah.
So when you rebalance, I mean, you're not doing this like every month. You're talking about like once a year?
Yeah. Now, there's a lot of research on this, how often to rebalance. Again, going back to the academic research, how often should you do this? The upshot is once a year is totally fine.
Give me the fourth one. Market. I don't know what that is.
Yeah, and I will just add to the rebalancing. I said it's totally fine to do it once a year. It's actually, what I meant was there's no benefit from even doing it more. There might be, may or may not be, depending on what happens. So there's no downside to even doing it once a year. So once a year is totally great. All right, finally, the market. So this one, we do end up every now and then in this situation where the markets might be a little bit frothy, they might feel a little bit high. And then other times where they feel like, oh man, they've really come down, but I definitely want to sell because they're just going to go lower, but they've come down. So you end up with these, and this is every few years. All right, that they might feel, be a little bit overvalued or a little bit undervalued. So you want to pay attention to not economic forecasts, what people say is going to happen this year, but kind of where the indicators and markers are. Are we hitting all-time highs? We've been at all-time highs for a while, and there's certain indicators that are that, or are we down 30% from a most recent high? And clearly we're in a trough. And those are opportunities to tweak your portfolio slightly. If you're normally 80% stocks, you could go to 75% stocks, or you can go to 85% stocks. Just a 5% little tweak based on where your portfolio is. And this is every few years. This is not like constantly checking in. This is just, every now and then, like a COVID, is when it happened and really like shot down. And right now it's kind of high. We've come down from the recent highs, but it's been high. The last couple of years have been great returns. So it might be a little bit high right now. So just a little tweak now and then can really do well.
So just to recap real fast, we've got the 4-part framework, and parts 1 and 2 are kind of on the front end, right? Your asset allocation, making sure it's going to these low cost index funds. And then you've got 3 and 4, which are kind of going forward, rebalance once a year. And then every few years, just check in how you're situated vis-a-vis the market. It's not a total, you're not going back to step 1.
No.
You're just tweaking to say, hey, maybe I want to be a little more defensive. Maybe I want to be a little more aggressive.
There you go, man. That's it.
All right. Well, that brings us to one of our favorite segments. I mean, we've only got a few segments, so like this is like
one of our other favorites.
I feel like I've just given a backhanded compliment to the listener question. We are on to our listener question. And I should say, as a housekeeping task, if you are a client of Mike's, you can email him your question. You can get a custom response just for you. But if you're not, and you just like listening to this show, anyone on the sidewalk can hear Mike's professional thoughts here on the show by emailing realfinancialplanning@gmail.com. All right. Today's listener question came from an idiot.
Who may or may not be sitting across from me.
I'm a listener. It's like the hair club for men. It's like, yeah. I'm the president. I'm also a client. Okay, here's what happened. All right. Well, I'll read the question. How do I transfer money from my brokerage account to my IRA? Okay.
Oh, wait, is that the whole question? How do I transfer money from my brokerage account to my IRA?
That's the whole question.
Okay.
But there's a tiny story, and we're going to do this fast. Here we go. I listen to this show. I pay attention when we're having these conversations, and I am one of those people who has too much money in my brokerage account. It's invested. That's good news, but it's not, I haven't put as much as I should have been putting into tax preferred accounts like my IRA. And so, I'm just going to call out. I don't think I'm exposing myself to hackers to say I have an account at Vanguard. Okay. And so I texted Mike. This is my listener question. Wait, I know I'm supposed to do this. How do I do this? I'm finding the system impenetrable. And you said something really kind of practically useful, which is, oh man, look, you're on a different, every single brokerage, every single firm does things a little bit differently. You're going to have to navigate this.
Yeah, that's exactly right. So every system is a little bit different from their drop downs and how they want you to go about this. But I just had to do this morning for a couple of clients. Let me tell you the brief steps. All right, it's very fast. You want to move money from your brokerage account to your IRA account, but like you said, it's invested. All right, so you don't have the money. So how does this work? First, number one, sell if it's $7,000 you're doing, sell $7,000 worth of your investment in the brokerage. Then you wait 1 or 2 days for that to settle. Now it's cash. Number two, transfer cash from your brokerage to your IRA, $7,000, just like you transfer from your savings to your checking account. You transfer $7,000. It's going to ask you for this year or the prior year what the contribution is for. So you do that drop down. And then about a day later or a few minutes later, 3, you invest the money that is now in your IRA.
I just called. And you know what? Kudos to Vanguard. Good job, you. They were super helpful. And I was able to figure out the sequence of the drop downs that they wanted. I'm over 50. So I was able to do 8,000. And my wife was able, and we have a joint brokerage account, so she could do it for her individual retirement account as well. And I was able to do it for 2024. And I was like, you know what? I'm just going to go ahead, do it now, get it done, do it for 2025. So I did them both. And you were able to, with Vanguard, it was cool. I was able to do it internally in one step. I didn't have to do the sell, wait a few days. They took care of everything on the back end. I just did the thing. Once I figured out, so it took me about 30 minutes. I'm not going to say that this was like a nothing process. You, dear listener and viewer, are probably smarter than I am. So I'm sure you can do it in 10 minutes or less. If you know, now that I know, I could do it in 3. So there you go. All right. But
there's no way you'll remember 2 years from now when you get to 2027.
No, and they will have changed it by then anyway, because that's how the world is. All right, let's get to our one thing segment. Mike, you have a wonderful de-stressing one thing to tell people.
Do you ever get overwhelmed by like the amount of email? Do you get up like in the morning or maybe at the end of the day and you go and like check your email and it's like...
That's a dumb question. Do I ever not get overwhelmed by the amount of email?
You know what you could do? You could not check. One, you could not check your email. Okay, no one's going to actually do that. So here's what you do instead. You pause your inbox.
Ooh.
And I might have mentioned this before. I use Gmail. There's an app or extension called Boomerang. You could just in a few clicks download it. And then right at the top, you hit pause inbox. And it pauses your inbox. So nothing is coming into your inbox. So you could check it a few hours later and there's still nothing there. And it's beautiful because the brain hack here is that a few hours later, you're in the middle of work. We were talking about last episode, batch your tasks. You're in the middle of a bunch of tasks and part of your brain is like, ooh, I wonder if somebody's emailed me. I want to like check and get a little dopamine hit. Well, now there's nothing there. You've paused your inbox.
So smart.
So there's nothing there. And so you have no choice but to keep on with the work right in front of you that you have to get done until the end of the day, until you're, go down, move a little bit, get a drink of water, and then sit back down and say, oh, now I'm going to tackle my inbox. I got 30 minutes here. And you press the unpause and you batch it and you do it all at once. So
dude,
pause
this is so
your
meta.
Inbox.
This is so meta because we're talking about batching tasks and one thing. And this could have been connected to the last one thing we did about batching tasks, but instead you did it one at a time. So it does totally connect because that was one of the pieces of advice that we were given in this training that I talked about in the last episode. Turn off notifications. Like if you're in a work environment where you get like Microsoft Outlook and it gives you that little box, it's like you have a new email. Don't shut that stuff out. It's so bad for your focus and attention. Turn it off. And that way you can focus on one thing at a time. And then when it's time for email, great. You use your whole ass. You don't half-ass your stuff. Use your whole ass on your email, which is probably what your email mostly deserves. And on that note, I don't know how to characterize that note, but it's a note. For Mike Morton, I'm Matt Robison. We'll see you next time.
Thanks, Matt.
Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. it makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.